right, welcome to Navigating Employee Benefit Compliance. Today we are covering ERISA and tax-favored employee benefit programs. So the specific agenda, we will cover health savings accounts, one of my favorite programs. In addition, there's the health flexible savings accounts. We'll cover both general health and the limited purpose FSAs. We will review dependent care assistance programs, educational assistance programs, a new Trump account program, which we have been highlighting since it was approved to move forward and will be effective on our 250th anniversary as nation, July 4th, 2026. And then we will do our standing compliance updates and agenda items. The next quarterly compliance external webinar will actually occur a week early on August 19th of 2026 due to a conflict. And just as a reminder, this session is being recorded. So moving on, we will be covering the component benefits that fall under Section 125 of cafeteria plan benefits. So the training objectives that we have today will be to review the core tax advantage component benefits, not Section 25 cafeteria directly. We want to understand the purpose and legal framework for these accounts or programs. We want to identify the core eligibility plan, documentation tips, and administrative requirements. We want to recognize whether they're subject to ERISA and which IRS status that they apply under, or which code they are covered by, and then spot certain common compliance pitfalls that can affect both you as the employers that offer these programs to your employees or the participants themselves. So moving on, let's first cover, again, one of my favorites, the health savings account. And the reason why I really like this program is that it has many advantages. One is triple taxation benefit, which we will cover. So some of the key features at a glance is it is a tax-advantaged account for qualified medical expenses, which we will cover. It must be paired with a qualified high-deductible health plan in order to get the tax-favored treatment for those contributions. Employee contributions often are taken pre-tax through payroll deductions or subject to the Section 125 cafeteria plan rules. Employers may also contribute to the HSA on the individual's behalf. There are investment options that go beyond just simple interest on these accounts, which are typically available as well. The withdrawals, of course, are tax-free if they are for qualified expenses, and employees actually account, which is portable if employment ends. So really, they're not use it or lose it. So some of the compliance and ERISA considerations is the actual high deductible health plan is typically an ERISA group health plan if you as the employer sponsors it. The HSA itself, or that consumer directed account, is usually not an ERISA plan if DOL safe harbor conditions are met. And so safe harbor themes are whether employee control over the funds, the portability aspect of most of these accounts, no employer control over investments or how the funds are actually being used, no employer representation that the HSA is an ERISA plan, and employer compensation tied to the HSA vendor arrangement. I should caution you that mid-year eligibility changes can be problematic, so really consult your relation advisors. excess contributions can also be a problem. So the employer themselves, if they're hiring somebody in a current year, do not always have line of sight into, and do not have line of sight into what happened when that employee was with a prior employer. I'll give you a great example. Me, last year I joined Relation. I was with the former employer up until the Friday before I started in at Relation, and my former employer, out of my last paycheck, capped off and took and maximized my contributions under that plan. So Relation wouldn't have had light into that. My last paycheck had up the maximum contribution, including my over 55 $1,000 exception, which we'll be talking about. So I made an election that ultimately did have to reverse. It was my error, and the plan did pay those dollars back in time so that when I filed my tax return, I did not over contribute. So you really need to watch those excess contributions. Unfortunately, you can educate your employees, but you won't always have that line of sight into knowing whether they've gone over with a prior employer or not, as an example. And then again, the FSA and the HRA rules, you have to be careful as well that you do not have both a general health FSA as well as a in that calendar year, as well as an HSA. So again, you may not always have that information. So let's talk about the triple tax benefits associated with the health savings account. The contributions themselves can be tax-free if they're made through the Section 125 elections and they are deducted through payroll. They can be tax-free. So again, there are limits to those contributions, but generally up to that maximum, they can be contributed tax-free. It is also tax advantaged because FICA taxes as well would be reduced to both the employee and the employer. So that's a good thing for both, for mutually beneficial to employers and their employees. There is tax growth. So any interest, or should there be investment options, capital gains and other things in that these funds can be invested in, do grow tax-free. And as long as while they remain in the plan, and then depending on how they're withdrawn, they may continue to have that tax-free withdrawal status as well. Moving on to tax-free withdrawals, as long as they are for qualified medical expenses, and we will talk about how that is defined under the IRS code. They may also take some deductibles, copays, and other dental and vision care. One of the things I use my HSA for is paying my long-term care premium automatically out of the account. So if something should happen and I'd be incapacitated, have it an auto withdrawal so that I don't lose my long-term care. Additional benefits is the post-age 65 flexibility, the aspect of not using it, the no use it or lose it rule that applies to the other programs, some of the other programs that we're going to be talking about. There is the portability, which is great. If employment ends, that portability of that account is available. Under the One Big Beautiful Bill Act for 2026, there was an expansion of HSA compatible plans, which included the bronze and the catastrophic plans on the exchange. That's for information only purposes for you. In addition, under the One Big Beautiful Bill Act, they did provide for a direct primary care fees that may also satisfy the qualified medical expense. And we'll dive into that a little bit deeper. So moving on, who can contribute? So an individual themselves must be HSA eligible to make or receive those contributions. They need to be enrolled in an HSA qualified high deductible health plan, which is the one that is subject to ERISA, as we spoke about previously. There can be no disqualifying non-high deductible health plan medical coverage. Limited exceptions do apply. But for example, a general purpose health FSA would disqualify from HSA eligibility, but a limited purpose FSA that's used for the purpose of dental and vision only could preserve that eligibility. The member can also not be enrolled in Medicare during that year. They cannot be claimed as a dependent on another taxpayer's return. Another aspect I want to point out is employees' dependents may allow, if they have dependents, may allow them from, enrolling them in coverage, will allow that employee to contribute to the HSA under family. But the actual individual themselves must be a tax dependent. So, for example, if you had a divorce situation where the employee does enroll all of their kids in coverage, but it's the divorced spouse that is claiming them as a tax dependent, then those medical expenses cannot be taken. But there is still advantage because you can family coverage into your HSA, and that does qualify. But the actual being able to deduct from an HSA to pay those dependent healthcare costs is not allowed. Something that most people oftentimes overlook. Coverage coordination also matters with respect to coordinating coverage with other plans. And then the catch-up contribution, which I mentioned, is for age 55 and over. It's a one-time catch-up contribution of $1,000 that can also be added to the maximum contribution limits for all others. So I do have highlighted here contribution HSA limits for 2026. For FYI, I also have the high deductible health plan minimum deductibles and out-of-pocket limits, but we're really not covering that specifically today, just noting there for your reference. So again, contributions, there is that annual contribution limit as noted on the page, and the one-time catch-up or the catch-up rules for each year for 55 and older. The annual contribution limits are indexed each year. So far, the $1,000 has not been. Eligibility, timing, and employer funding designs can affect those maximum contributions. So you do have to look at what the employer is willing to contribute, as well as the member themselves, and not exceed those contribution limits as indicated. As far as distributions, qualified medical expenses are generally tax-free if they comply with the definitions of qualified medical expenses in the IRS tax code, which I will point out later. The non-qualified distributions, if any, so should they exceed and have a non-qualified medical expense that's withdrawn, then those are generally taxable as ordinary income. And then documentation does fall on the individual themselves, unlike the FSA that we'll be talking about, where the employer and their vendor must document and substantiate the qualified medical expense on behalf of the plan. So operational controls are very important. I think the biggest is really educating the individuals so they understand if they enroll in Medicare, that they are no longer eligible or that they could be disqualified, because you may not have that site into that information directly. Accurate payroll setup, along with that year-end reporting, which will be will be very important to ensure an accurate W-2. And then again, participant education and their education over substantiation is required. So let's talk a little bit about the plan structure and compliance considerations. They can be these plans typically are employer-sponsored, tax-advantaged accounts for eligible out-of-pocket medical expenses. Employer contributions are usually made through a Section 125 cafeteria plan using salary reductions through payroll. The HSA itself as a component benefit is established under Code Section 223 of the Internal Revenue Code. The definition of a qualified medical expense to be reimbursed tax-free is defined under IRS Code Section 213D. That is where what a qualified medical expense will be defined as. Employer and employee contributions are reported on Form W-2 in Box 12 using Code W. Typically, an HSA is not subject to ERISA, as we discussed, although the high deductible qualified health plan is. It is not typically subject to COBRA, but it could reimburse COBRA premiums. So, once a person is eligible for COBRA. And if there becomes employer involvement, then there could also be subject to HIPAA and ACA requirements. Now let's talk about flexible spending accounts. So key features, the health FSA is one of the component benefits that can have the Section 125 cafeteria plan treatment under Section 125. The tax-advantaged account itself is defined, the medical expenses, again, are defined under Section 213D. The plan itself, the limited purpose, is under Section 105H. Employee contributions that are taken through an FSA as opposed to the HSA are irrevocable, even if there are errors. It's a very high bar. There has to be negligence in order for it to be revocable. The 2026 reduction limits are plan year, so they're not calendar year limits, and that is $3,400 for plans new and renewing in 2026. That is up from $3,300 for plans new and renewing in 2025. So if you have a mid-year plan, pay attention to those limits. They are plan year limits, not IRS calendar year, or not calendar year limits. Employer contributions, again, may also be up to an additional $3,400. There are some special rules on how much was actually taken that we won't cover here, but in general, employers could contribute up to an additional $3,400. The general purpose health FSA is incompatible, as we mentioned before, the HSA eligibility. A limited purpose FSA restricts reimbursements, but typically to dental, vision, and sometimes post-deductible expenses. There is no double dipping, though. You can't be benefiting from two different plans. You do need to pay particular attention to drafting and administration to preserve the HSA compatibility. Generally, an FSA is use it or lose it. However, during COVID, when a lot of members were not able to utilize the benefits that were put aside in the FSA, some additional rules did come out of COVID. So some good things happened. Plans can consider a carryover amount. So not fully use it or lose it, but a plan can choose to have a maximum cover amount of $660 into that new plan year. So that is one of the drafting tips and design tips that a plan can consider. If they don't want to consider a carryover amount, they may consider a grace period carryover of spending of an additional 2.5 months. So that's an additional 2.5 months to incur claims or incur expenses. That should be distinguished between runout, which may allow up to 90 days after a plan year where expenses have already incurred to submit claims for reimbursement and get those dollars back. So again, a carryover of 660 versus a increased grace period of up to 2.5 months to incur expenses versus a run out where would have to be incurred before plan year, but the run out period is up to 90 days, can be provided if provided in the FSA plan design. So pay particular attention in designing your plans and documenting that in your plan documentation. And again, these plans are subject to ERISA as they are considered a welfare group health plan. So certain compliance requirements we've talked about. Because they're ERISA, there is a need for a plan document and a summary plan description. They do need to be coordinated with the Section 125 plan and or a RAP if a RAP is going to go around all of the various component benefits that we will be talking about today, in addition to the core medical plan. There should be a claims and appeals process, and that's not just for medical claims, but a broad denial of benefits under the plan in general. And then looking at that COBRA to determine whether or not there really does need to be, if the FSA, it is subject to COBRA, it's really about whether there's any funds left for that individual to continue. So there is an analysis that does need to be done between the COBRA administrator and the FSA administrator. And then other compliance considerations, these plans are subject to both privacy and security rules. They are subject to ERISA, as we've already discussed. And non-discrimination testing must be done in both the Section 125 aspect of the deductions, the tax favored deductions for those contributions, as well as the 105H, which governs the plan itself. Again, contribution limits and other considerations. An employer's salary reduction under pre-tax contributions are capped at statutory dollar limits that are indexed for inflation, other than at this time, the $1,000 over age 55 additional contribution. The IRS annual limits, that was for I'm sorry. Yes, the FSA does have our index limits, and there is no 55 contribution for this one. The annual limits, again, are on a plan year basis, so really watch for that. And it was $3,300 for plans new and renewing in 2025, and $3,500 for plans new and renewing 2026. Again, you can have additional contributions by the employer. The 34, there are some special rules that would limit that up to 3,400, but that could be on top of what the employee themselves contributes. Most of them most health FSAs qualify as accepted benefits. That does allow for requiring other group health coverage and employer contributions. Again, these are those special rules where it might not be the full $3,400. The other drafting hint is for mid-year plans, or plans that don't renew on a calendar year basis and are mid-year policy years that pay particular attention in your documentation as to whether or not you want to have them prorate. So in other words, if you have people that are hired after January 1, did you want those contributions to be prorated? It is not required. Funding contributions and election rules. Primarily, these accounts are funded through employer pre-tax deductions, which are under the Section 125 cafeteria plan rules, as we've already indicated. They may contribute, employers as well, but all of this is subject to non-discrimination testing, again, of both the Section 125 aspects as well as the Section 105H, which is the component benefit themselves. So that's being tested. And there are different definitions of highly compensated individuals in both of those definitions. Slightly different, but you do need to pay attention to that as to who is considered highly compensated individual under both of those tests. And again, mid-year election changes are restricted and generally require a permitted code section 125 status change. So be careful. You can't just change the FSA benefits and component benefit without impacting the Section 125 cafeteria plan. And your Section 125 is probably very limited as to when you can make those mid-year plan changes. So the one aspect that is the negative is the use it or lose it rule aspect to this plan. Unused funds are forfeited at the end of the coverage period unless there is that carryover option or grace period option, as we've discussed. Plans may offer one or both of those options, not both. Carryovers also require a timely cafeteria plan amendment, generally by the last day of the plan year that it is being carried from. And then plans may allow a run-out period for submitting claims after year end, but it must be documented as well. Timing and employer risk. Health FSAs generally provide 12 months of coverage. Sometimes there's a limited exception for a short year plan. The uniform coverage rule allows the full annual elected amount is available from the start of the plan year. So if an individual leaves before the end of that policy year, they can continue to use those benefits after they leave because they were eligible from the beginning. That is where those COBRA rates are important. And so that COBRA administrator needs to understand if there are still balances left and to offer that COBRA election to the individual. They may not take it and may not elect it, but they must be offered COBRA rights if there is a balance left in that FSA. So it does need to be coordinated between your COBRA administrator as well as the FSA vendor. And so it does create some employer risk if large claims occur and employment has ended because the member is not still adding. So the employer does bear that claim risk that may not be covered because there is no further contributions that are coming into plan. So what can and cannot be reimbursed? Again, the reimbursements, generally follow the same Internal Revenue Code Section 213D that defines what is a qualified medical expense. They also generally can include some deductibles, copays, and coinsurance. Also, dental, vision, exams, and treatment. Hearing aids is another case. Fertility treatments and smoking cessation programs. They are all available typically as qualified eligible expenses under the FSA. What is generally not eligible is insurance premiums, including COBRA premiums. Unlike the HSA that we talked about, those premiums are not allowed under an FSA. Cosmetic procedures, including teeth whitening, are, unless they're medically necessary, are not eligible. Car seats, long-term care premiums, and other typical services that were covered under the HSA are not allowed under the FSA. The CARES Act did expand reimbursements again during COVID. There were some things that came out of the CARES Act. The over-the-counter medicines, some are reimbursable with a prescription, including except insulin, and menstrual care products are also reimbursable. So substantiation and operational controls. This is not on the employer or the employer's vendor that they choose to ensure that the substantiation is being performed. Plans must substantiate that they qualify as qualified medical expenses. Debit card programs can rely on this substantiation. Depending on your vendor, they are looking for approved vendors. Sometimes college health clinics can be problematic as they are not already applying for that status as being approved. So you may have some individuals that go get care from a college that may or may not be an IRS approved vendor. So that needs to be substantiated. Auto substantiation for certain deductibles and copays could occur. And again, we talked about there are certain and providers that do need to be qualified. So a good vendor will do this on behalf of the plan. Plans may also allow limited exceptions to substantiation, but again, that will be subject to IRS guidance. And again, a good FSA vendor will keep those rules and have that education available to your plan participants. Some operational takeaways is aligning those card rules with, and documentation retention. The plan will need to retain that documentation for significant periods of time. It is subject to HIPAA and privacy rules, and you need to have good trails in place. Again, we talked about COBRA, when it must be covered. Health FSAs are generally subject to COBRA unless the employer is under 20 employees or a church plan. Special COBRA rules do come into play. Again, if they've already spent under all of their balance under the FSA before they leave employment, then generally there would be no COBRA obligation required. And again, it must be offered, though, to those that have underspent their account, whether or not they have actually contributed the full amount. Key compliance obligations, again, privacy and security, health FSAs are subject to HIPAA with very limited exceptions. We've already talked about the ERISA aspects and the aspects that you need to pay attention to with respect to plan design, claim appeals procedure if they are denied under the plan. Reimbursement, as an example, they do need to have their rights to pursue, and there is fiduciary responsibilities. And then non-discrimination, there's actually the two tests that do need to be performed, both the non-discrimination testing under Section 125 and 105H. Governance and oversight, we've talked about many of these, but the cafeteria plan design needs to be documented, such as the carryover, the grace period, the runout periods. The SPD, there needs to be a plan document and an SPD, just like other ERISA required documents and notices. Proration, again, if you want them to be limited to, if the policy year is 3,300 or 3,400 in 2026, come January 1st, what is the expectation? Do you want them to prorate or not? Do you want them to be able to take the full amount? You do need to document if proration will be required. It is not implied. And then again, carryover or grace period rules should be defined as well as run out. From an administrative standpoint, the eligibility rules and enrollment process needs to be handled properly. Claim substantiation procedures do fall. The obligation is on the employer and their vendor, including debit card controls. Consistent communication of this run out, grace period, and carryover rules from the election packet and notice and open enrollment to the actual plan document and SPD rules. That will be very consistent, and also needs to be the Section 125 plan documentation rules need to be considered. COBRA notices, again, we talked about that and the coordination if there are balances when the individual terminates employment, HIPAA privacy and security considerations, non-discrimination testing, and any corrective action if needed by the end of the year, so that the highly compensated individuals do not ultimately get taxed, because it would be the favored highly compensated individuals that get taxed, not the non-highly compensated individuals, should the plan be considered discriminatory. And then, of course, maintaining amendment logs and following any adoption dates and rules are important. This is a chart that will be in the recorded packet that will be sent out. For your reference, we have discussed all of these. So now moving on in our remaining time to dependent care assistance programs. The purpose, just a high-level overview of the dependent care assistance programs. What it does is it allows employees to pay certain dependent care expenses on a pre-tax basis. It's designed to enable the employee and their spouse, if married, to both work, employment for work, and receive that tax favorable treatment. A tax exclusion or benefit is provided under the Internal Revenue Code Section 129, which also requires non-discrimination testing. It is commonly offered through a Section 125 cafeteria plan, just like we discussed with the FSA, through salary reduction. So again, both the Section 125 and the Section 129 aspects are tested through non-discrimination testing. In 2026, the annual calendar year limit has increased. The One Big Beautiful Bill Act did provide that for calendar year 2026, not policy year last year, 2025, but for 2026, a plan could offer to their employees an increase from $5,000 to $7,500. It is not automatic. It must be documented and provided in the plan documentation. It could be increased to $7,500 for single employees or married filing jointly. So there are some things that you as a plan will not know. You will not know, for example, if that individual is married, will be filing married jointly. And so it's important that these aspects are educated on at open enrollment so they understand the impact of over contributing. And then again, if it's married filing separately, then they are limited to the 30 or 3,750 if the plan increased from 2,500 to 3,750. It's not an automatic. Again, if you had difficulty prior to the One Big Beautiful Bill enactment of this increase, you may choose not to do that unless you really educate those non-highly compensated individuals to really start using this benefit. So you will want to consider whether that's just going to make it further problematic for the highly compensated individuals or not. Things to consider. It does cover employment-related dependent care expenses for qualified dependents. It does require careful substantiation by your select a vendor that carefully substantiates, and then there is payroll tax reporting because of the calendar year aspect of the single or married filing separately. There also is another type of dependent care tax credit that these individuals can also take advantage of. Common issue is confusing DCAP rules with health FSA rules. There are some participation and tax credit coordination aspects. An employer-sponsored benefit, if you are offering this as an employer-sponsored benefit, employees can elect contributions. Employees, again, coordinated with the Section 125 plan, and employees incur qualifying dependent care expenses and meet the work-related requirement that either both are working, one is working and seeking employment, both are seeking employment, both are in a qualified school program. So there are some special rules to consider. Again, I just mentioned that employees also may claim a federal child and dependent care tax credit. So the individual needs to seek their own tax advice and counsel on which they should elect to use. The same expense cannot be used for both the dependent care tax credit purposes and under this program that the employer offers. Qualifying dependents. Again, qualifying children must be under age 13 to be eligible for qualifying dependents. However, there are some special rules under a spouse who's incapable of self-care, who lives with the employee for more than half the year. A dependent themselves who's incapable of self-care, who lives with the employee for more than half the year. And there is a special rule that if a child turns 13 during the plan year, and that's the plan year, and expenses incurred before the birthday may remain eligible. So there are a few moving pieces. The work-related requirements, expenses must enable the employee and spouse, if married, to work or look for work. If married, both spouses generally must have earned income, and the exception does apply if one spouse is a full-time student or incapable of self-care. Expense must be for the care of a qualifying individual, not for education or purely personal benefit. Compliance requirements, it must be maintained and administered pursuant to a written program or plan. Non-discrimination testing does apply and would be for both the Section 125 aspect as well as the Section 129 aspect of the component benefit. Only eligible dependent care expenses can be reimbursed, and the DOL guidance generally supports that properly structured DCAPs are not considered ERISA welfare plans, but there are some primary risks: poor substantiation, ineligible reimbursements, and missed annual non-discrimination testing. Again, this chart will be available to you in the materials, and we've covered high level, but this basically talks about the different types of qualified expenses, which ones are considered eligible, and those not eligible. The funding, proof of expense, and controls are important considerations. Employees elect an annual amount. Funds are available only as contributions are being made. This is distinguished from the health FSA that we talked about. So if a person leaves employment, it's only what they contributed that was available. Claims must be tied to care for the qualifying individual, so that the employee can work or look for work. Substantiation generally includes information surrounding the provider themselves and the dates of service. Plans must, so they must have a TIN number associated with them. So if you're going to use your sister as, for example, as a qualified daycare person, they need to apply for a TIN, and they need to claim that on their tax return. And then the dates of service, amount paid, and the description of the type of care is important. And again, you cannot have duplicate reimbursement, no double dipping. And then again, we did already talk about those limits of potentially, if you want to, you can increase those from $2,500 to $3,750 for individuals, and or $5,000 to $7,500 single, or those filing jointly. Be careful on mid-year changes and run-out rule. Mid-year changes are very limited, again, subject to what changes you can do on the Section 125. That needs to be coordinated. These are irrevocable elections, unless there's some sort of a qualifying event that allows you to change your elections under the plan rules. And again, plans typically offer a run-out period so that they can get those dollars in, but it would be required to be incurred prior to plan end. Again, employer reporting with the form, with the payroll vendor, the form W-2. And again, employees need to consider whether or not they want to file for the dependent care tax credit as opposed to utilizing the benefits from the program. The non-discrimination testing, as we discussed, there are various tests under each. There are different rules for highly compensated individuals, as discussed under Section 125 and Section 129. So be careful and watch for those definitions. Documentation we've already talked about is very important. The payroll and the administration. Again, you want to make sure the payroll deductions are capped appropriately, that the claim substantiation is being done by the vendor, and that the deadlines and run out are clearly identified in that plan documentation. The last benefit we're going to, We will be talking about the tuition reimbursement and just updating you on the Trump accounts. So this is on the tuition reimbursement program or educational assistance programs. Why do you do these? Primarily for recruitment, retention, and workforce development. It's a good thing, and you want to encourage your employees to seek out and increase their knowledge. And so it does support recruiting and retention by encouraging that skill development as well as career development, may cover higher education and job-related advanced training, and it can improve productivity and job satisfaction. The coverage scope and reimbursement levels will be discussed as far as, again, the course itself needs to be tied to the employee's current role or career development. So it doesn't have to be exactly on point, but should be with their current position, but a career development opportunity. There's optional coverage sometimes for tuition, books, and fees. You do need to set, there are reimbursement limits. The IRS does allow up to $5,250 per employee per year on a tax-free basis. And an employer may reimburse 50, 75, or 100% of eligible tuition costs. As to payment, eligibility, payment, and timing, the academic, it is good documentation drafting tips to define the academic requirements. Are you going to have a minimum grade required or GPA if it's a college institution, for example? Some course just pass fail. Determine whether employees pay upfront or will you require them to submit expenses after they've completed the course. Document required proof and timelines to ensure consistent administration across all of your employees. And it does require a written plan document and reasonable notice to employees. So again, you should define who are eligible employees. Will it be offered to full, part-time, any tenured requirements, applying eligibility rules consistently so there's not discrimination is important. Inconsistent approvals can create risk to the employer if not applied consistently. And again, they must satisfy non-discrimination rules and be offered or utilized by more than 5% of owners. Again, Trump accounts for children. We have been updating you on these since they were passed almost a year ago. They, again, were created by the One Big Beautiful Bill Act, which was signed into law on July 4th of 2025. The initial guidance issued also proposed rules on a $1,000 pilot program, which was funded by some generous donations of Dell and some others that have jumped in. Effective for, these are officially effective on July 4th of 2026, which is when the initial contributions can be done. So it cannot be withdrawn from a paycheck prior to July 4th of 2026. The aggregate annual contributions, which will be COLA adjusted, are initially $5,000. There are some, like the $1,000, that don't necessarily have to be counted towards that $5,000. So employers can contribute up to $2,500 per year, and individual and others can top off more. But the employer themselves, it's capped at $2,500. The individual, it's capped at $5,000 with some limited exceptions, such as the pilot contribution. Structure and timing, it is a tax advantage savings program for children under the age of 18. They are structured similarly to a traditional IRA, not a health FSA or DCAP. They do have investment earnings growth that is also tax deferred. Contributions again begin July 4th of 2026, which was 1 year after enactment. Contributions can be made by a variety of people. The children, child or beneficiary, the parents or guardians, grandparents can contribute, employers, and philanthropic contributions or third parties can also contribute to an individual. Children born between age 2025 and 2028, again, may qualify for this $1,000 federal pilot contribution, which has, as mentioned, been funded, at least initially. Whether it remains through 2028, we'll continue to update you through bulletins. Contributions are capped at that $5,000 with COLA adjustments and some exceptions for some additional dollars. Withdrawals themselves are generally restricted until that child turns age 18. That growth period does grow tax-free until that distribution. Generally, it will follow, again, traditional IRA rules. It seems like it's those vendors that have supported IRAs that are jumping into this. It is not necessarily the FSA, health FSA, or those types or DCAP vendors that are necessarily jumping in to support the accounts themselves. So pay particular attention to that. And these must meet certain eligibility rules as far as what type of funds that they can be included in, and there is cap on what type of fees can be associated with these accounts. So there are some special rules again on the accounts themselves. Contribution limits, we talked about that, and again, there are certain contributions such as the $1,000 federal pilot contribution that does not count. And then during the growth period, we talked about that tax-free growth. Again, taxpayers themselves will establish their own Trump account using IRS Form 4547. We don't typically, nor do you typically, counsel them. They should seek a guidance themselves from their tax professional, to make sure that they fill out the Form 4547 and make that election properly. And what can employers do? They can contribute to the, although it's capped at the $2,500, and it would not be included in that employees. Again, that would be tax-free if it's set up properly. And then there is the overall limit that the employee and the employer cannot exceed the $5,000. And then again, there must be a written plan document for the employer to comply with these rules. And again, non-discrimination notice and reporting is similar, and we've covered some of these in prior. Again, we've talked about the setup and that they should seek advice from their own tax professionals. So that's the end of the content portion surrounding the ERISA and tax-favored advantaged accounts. Level, I just like to cover some deadlines. I am sure all of you know by now that June 1st is the deadline for RxDC reporting. It's usually a shared responsibility between TPAs, carriers, and the health plans to ensure that that deadline is met by June 1st, but I'm sure all of you have already had that, have already met that deadline for this reporting period. Then coming up is July 31st, 2026. PCORI, please reach out to your relations service team if you have any questions surrounding PCORI fees and how they are calculated. Again, the fees do increase each year on October 1st for plans that are ending either prior to 2000 or prior to the October 1st. So it's not a when the plans are new and renewing begin date, it's based on the ending date. And so each year there is a PCORI fee adjustment on October 1st. And so for this year, it did go from $3.47 to $3.84. And then September 30th, the summary annual report is also available. Both the PCORI and the summary annual report, you could file for an extension, although it's not typically done. And then October 15th, you have the Medicare creditable coverage notices. Again, the recommendation is to send to all participants, even though the law only requires Medicare eligible. And the last is the gag clause. So we are right at the top of the hour. Thank you. The recording and presentation will be available to all of you. And have a great rest of this month. And we will see you again August 19th. Take care. Thank you.